Hello and welcome to Trading Hour live from the CNBC TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me today is Hormis Patakia. And another day of fall that we're seeing in the markets, though in last couple of minutes, we are seeing some recovery that has come by as well. So the Nifty is off 100 points from the lows of the day, courtesy the moves that we're seeing in the Bank Nifty. So that should come up for you on the screen. Yes, it continues to be below the 26,000 mark. That was a level that we broke yesterday, and we continue to be below that mark on the Nifty. But just pull up a Bank Nifty currently, because SBI too has gone to the day's high. So Bank Nifty is the one that should be on your radar. There you go. There's been a swift recovery from the lows of the day. SBI at the day's high. Nifty PSU banking index is in the green today. We saw some recovery come by in the realty index as well. So we'll watch out whether that will continue or not, or we'll see another bout of selling in our own markets. In terms of individual names, we do have something like an ITC, which is at the day's high. Shriram Finance is the other one. SBI, I spoke about it already. So some of these stocks which will be on our radar now. But all in all, continues to be another weak day. Mid caps, they continue to underperform. 0.4% gone there. Small caps also following suit. So a lot of moving parts. There again, there was a recovery, and we have been consolidating around those levels. So it will be important to see whether we see further losses from these levels, or there is some buying on dips right now.
Sonal, it still looks like some optimism that you can take, even if it is the weekly expiry for the Nifty contracts. But at the start of the session, it almost felt like a mirror image of yesterday, or almost felt like almost similar to what was transpiring yesterday. We had 95 stocks on the mid-cap index that were in the red, 98 stocks on the small-cap index that were in the red. Almost every constituent of every sectoral index was trading with losses. But it's a 100-point recovery from the lows of the day, 25,728. The intraday low on the index, and that is from where the index has reversed and has staged that 100-point recovery. And a lot of those bombed out names from yesterday are seeing some bit of reversal from lower levels. Keynes Tech was down 12.5 yesterday, was down 12.5 last Friday as well. That is up 6%. That's the top gainer on the Nifty 500 today. And a lot of the other names that were beaten down in yesterday's session, Sonal mentioned PSU banks. Even PSU banks were among the top sectoral losers yesterday. Realty index was the top sectoral loser yesterday. So all of them seeing some bit of buying interest coming in at lower levels. Of course, the news flow driven names, LT Foods continues to be the top loser on the Nifty 500, still down 6%. But a striking feature among the losers today, though, is Asian Paints. Crude prices are down. It's not as if the crude prices have seen a very sharp rise or something, anything of that sort. But Asian Paints still at the lowest point of the day, still no recovery from the lows, still 4% lower on the stock. But it's seen a bit of a run up in the last 1 month or so. So that is one striking feature amidst this recovery. And Swiggy is the other one. And that one is now back above its IPO price, and amidst all the battering that the broader market names are taking, this one is holding out as of now, still 2.25% higher on Swiggy, back above its IPO price of 390. But to understand the market fall and the factors leading to that, we caught up with Samir Arora of Helios Capital and also with Vikas Khemani of Carnelian Asset Management Advisors. Listen in to what they had to say.
Right now, it looks like somebody is giving up on India in terms of selling. I guess I would call it indiscriminately. This looks more like dumping. Now, many people say that some of the PMSs, which were exclusively or mostly into small cap stocks, are shutting because they have been doing badly for 1 or 2 years or 2-3 years. Not sure what the story is. But in general, today doesn't look like a day from which you should draw a conclusion that somebody is seriously looking at it and has decided after when the year is about to end that this is the time to sell. There are many reasons to buy. First reason is to look at how good our market has been since March of this year. Since March of this year, the Indian market is up maybe 15-20%. Mid-cap stocks are up maybe 25%. If you look at it from October 1, Indian market has outperformed the United States even till right now, even including the US dollar. I mean, Indian market in dollars. You can see it right now. You can show MSCI India from, say, September 30th, which means for the current quarter, and compare it to China, compare it to emerging market index, compare it to S&P 500, compare it to NASDAQ. India has outperformed. What I'm trying to say is that although on a yearly basis it looks bad, but if you look at it from We are not saying look at first quarter. We are saying continuously from March 31st to today or March 15 to today, or you look at it from this quarter to date, which means it has changed a little bit.
I've heard is that there was a little bit of margin funding selling which came through, especially from the retail investors, is what I've heard, but there's no way for me to verify that. And I think broader market trend, as you rightly said, has been there for some time. Large caps have been, kind of leading this rally in last, couple of months. To my mind, nothing changes. Market continues to remain sort of one of the most promising market. It's a stock pickers market. That's where we always focus. So I think that journey continues. And these kind of times only give you more opportunity to look at interesting ideas, which otherwise, in bull market, you don't get at a good price.
Okay, that is some expert opinion coming in from the fundamental lens. Let's now get in Rohit Srivastava, founder India Charts and Strike Money, to take a few questions on what the markets are looking like from a technical and the charts point of view as well. Rohit, good morning. Thank you so much for joining us. You know, we had spoken to you on 21st of November. You had indicated that 26,050, 26,000, that could be an important support level from which Nifty could bounce back. But we are way below that now. And even mid caps and small caps, you expected them to bounce back. What went wrong in last 15-20 days for Nifty to see that fall, especially in the last 3 days where we are seeing relentless selling that has come by?
Yeah, so it's essentially been the broad market that has caused the trouble. And yesterday we saw it spill from the small cap to the mid cap. So that is the first stage of deterioration that we saw. We haven't still seen it go from mid cap to large cap because the Nifty, while it may have broken 26,000, I'll put the major support at around 25,000, 880 to 870, somewhere there. And 800, I say 20, let's say 25,800 to 27,770. Yeah, that's the correct point. So 25,800 to 25,770, that range, if we hold, we definitely get a bounce over the next 1 to 2 days. So that is at least the short term. Volatility will cool off. And if you look at the RSI of the small cap index, it has actually, fallen to around 23, 22, which is an extremely oversold reading. Our own Nifty proprietary swing indicators down to around 11. Now, if it was single digits, it would become a screaming buy. But even at 11, we say it's pretty oversold for a pullback. So a pullback is definitely on the cards here over the next, 1, 2, 3 days. The question is what beyond that? So therefore, once we do see that pullback, what we really want to see is that the whole market starts to recover. We want the Nifties to start sustaining again above the 20-day average. And once we see that, then the comfort, would mentally return, for the market to go back to new highs. But let me just put out this that because of the breakdown in the small and mid caps, we have created some potential risk, not confirmed yet, that the Nifty can maybe retest, 25,500 or 24,500, but we can't be sure of that. This would not spoil the long-term picture. But if there is, further selling after a bounce in the mid and small caps, it can even spill over to the large cap. Is a risk that we'll watch out for in the next 2-3 days. But definitely, I think we are very oversold here. We should get a pullback.
Rohit, so both sides of the question. So once you're trying to say that if this selling pressure in the broader markets continues, you may have that risk of the Nifty falling towards 25,500 or maybe even 24,500 on the downside, if I interpret that correctly. The second bit of the question is, since you mentioned the mid and small caps, that has been the talking point for the last couple of weeks, that weak market breadth, that deteriorating market breadth. Is there anything that is emerging on the charts on either the mid caps or the small caps that this selling, that relentless selling that you have seen in the broader markets is coming to an end or at least slowing down, if not ending?
I definitely think you're at the fag end, because when I scan across stocks, the RSIs for a lot of these individual stock names in the small cap, and even the good ones which we are tracking where earnings are growing at 50 to 100%, and the P ratio has dropped to like 40, 30, 20 because of the growth. Even these stocks have taken a hit and their RSIs are going into 24, 23, 27. So they're all getting oversold simultaneously. So it does create a case that, this is not a point at which you should be selling. In fact, it's an opportunity to buy. So I've already started nibbling some of these stocks in that group today. But what I'm just trying to highlight is the near-term uncertainty. that we are not clear of. It's possible that this is it, the worst is over today, and things just return to normal in the coming days. But just want to leave that open for a day or two to be able to be, doubly sure. If I look at breadth indicators, so as you asked, that is there something telling us that it's gotten as far as it should? The 20-day advanced decline ratio has entered the typical, very oversold territory. But it's still there, it still has to bounce out of that. So while we see it there and we feel that, yeah, this is an extreme, even if we look at the number of stocks in the small cap index, which are above the 20-day average, that has come down to almost single digits, so that means most of the stocks are below. And that is again sometimes a near-term indicator of a potential bottom. So we have a lot of readings coming together. But is there something else, because what happens when we look at things like RSI, the market bounces back for 2-3 days. These indicators come out of their oversold territory, and then another round of selling shows up. That's the only thing we want to really avert. And that's why I said that we'll watch it for the next few days from what looks like already a very oversold condition.
Okay, what looks like an oversold condition. By the way, there is some recovery which is underway in the mid caps and small caps. Those two lines, the advanced decline ratio, they're almost converging. So we'll watch out for what kind of gains or recovery we see from the lows of the day. Mid cap index is at the day's high. Small cap index too briefly turned into the green as well. Rohit, you mentioned that maybe the worst is over. We could see it for next 1-2 days. For the near term, there could be some pain, but that might not continue. Which are some of the sectors which could contribute to the recovery from here on? You had indicated banking is one of them which should do well. Do you continue with that thought?
Yes, I think the interest rate sensitive sectors, so that includes financials, followed by autos, followed by metals. I think these segments are due to do pretty well. I'm not sure real estate right away, but at some point of time, as you continue to have rate cuts, that also gets affected. But these three would be top of the mind: banking, autos, and metals, to see a positive impact of the rate cycle. So financials definitely have been outperformers over the last couple of weeks, and on a pullback, there would be opportunities. There may be some rotation because you've seen PSU banks, for example, do exceedingly well. It's possible that private banks that were lagging behind or had pulled back in between now start performing. They have held up pretty well. If you look at the likes of ICICI Bank, HDFC Bank, or Kotak Bank, they've actually hardly fallen in this 2-3 day sell-off that we've seen in the broad market. So they are showing exceptional strength, and any holdout would mean that they actually start doing much better than other parts of the market.
The Nifty Bank has turned positive, showing on the Nifty as well now. Rohit, just before we let you go, very quickly, if you could tell us about the EMS names. Suddenly from the street darlings, they have suddenly become the knife, the falling knife you don't want to catch. Is this a time to nibble into these EMS names, down 40-50% from their peak, the Canes, the Sirmas and the PG Electroplasts?
I would think so, because growth stories don't just end in a whiff. We have to first believe that we are in a bull market, and typically the themes that kick off a bull market continue to remain and be there till the entire course of the bull run. And so I don't think we are at the end of the bull run, and that means that as in when you get good opportunities on declines in any of these key sectors, EMS, or whether it's defense or PSUs, which have been really beaten bad, they are good investment opportunities.
Okay, take that point. A lot of factors that go into buying a particular stock as well. So markets may be factoring in a lot of those other factors right now. Thank you so much, Rohit, for joining in today and taking us through your thoughts on what the markets are looking like. We'll slip into a short break. When we come back, we'll focus on the bond market with Manisha Gupta. Stay tuned for that.
"26 years of CNBC TV18. On Street.
Welcome back, and this is our very special new offering, Bond Street, where we get you all on the money markets and a lot more. And of course, today we will start by talking about government and corporate bonds. These are the two most important ones, and I'll take you through on what they mean, how can you invest in them, the risks and the returns therein as well. So starting with the government bonds, first of all, these are debt securities that are issued by national, state or local governments. Well, when it comes to the government bonds, you can buy a bond which you lending funds to the government. This is the whole idea about you buying bonds, because you're lending, the government is borrowing this money from you. The government for this pays you a regular interest as well, and then the principal is also paid back to you during the maturity. So your initial investment comes back to you after the kind of period that you have chosen. This could be over months, or this could be over a decade or decades as well. So now when you look at the government bonds, therein the risks herein are on the lower side, because it's backed by the government taxing power. They are considered virtually free from a default risk. So the government bonds or the debt in your portfolio clearly does a lot of wonder there. Now within this as well, it's a predictable income, because it provides fixed or floating interest, and it appeals to conservative investors as well. Usually when you're making a portfolio, it's said that 60 should be equities and 40 debt, and this is exactly where they feature in. Well, there are a variety of maturities as well. As I said, they're available for short term, which could be some months, and then long term as well, which could be decade running into various decades as well. Funding purpose is this is used for the money that the government borrows from you is used for infrastructure, budgeting deficits, and general government operations as well. So you can choose between that as well. And then it also is about the types of G-Secs that are available in India. You have central government bonds, state government bonds, and treasury bills as well. Why people buy them? One is, of course, because of the safety. The capital preservation is a key goal here. Second is stability, because of the reliable returns that are offered here. And third, of course, is the debt allocation or the portfolio diversification that you can do via this. And conservative investment portfolio must absolutely have this clearly. And in the recent times, we also have seen good returns come in from this as well. The other one, of course, is corporate bonds. These are debt securities that companies issue to borrow money from the investors, that is you. So in this case, you are lending money to the company, you are buying a bond for a coupon from them. The interest payments, well, the company pays you a fixed interest, usually semi-annually, which is called the coupon. And then the principal repayment happens after the overall face value or the overall period for this gets done with. Take you through an example as well. So if you were to invest something as small as 1,000 rupees in a bond with a 5% coupon and a 5-year maturity, that would pay you 50 rupees interest yearly and the return of 1,000 rupees after that 5 years. So not only do you get your money back, but you also continue to get that interest on an annual or a semi-annual basis. Now, the key features for corporate bonds are that you're a lender and not an owner. And this is slightly riskier than the government bonds, but compensated by higher return rates as well. And then it is secured and unsecured bonds as well. There are two types there. Secured bonds have collateral, while the unsecured ones do not have that. If you look at the Indian markets therein, well, the bonds seem to be doing quite well, especially in the last couple of years. The recent G-Sec auctions have seen very strong demand as well. The corporate issuance seems to be picking up across NBFCs, infra and manufacturing. And when you look at the corporate bonds, they seem to be getting a lot of sense because of the better yields that they provide, transparency ratings, clear structures that they have, and the recent progressive SEBI regulations also are making it very, very lucrative. But with that, let's chip into a break and more on the markets and stock specifics on the other side of this break.
TV18 and India Bonds presents Bond Street. "26 years of CNBC TV18.
Welcome back. The losses are now into double digits as we speak, 95 points lower on the index. So it's 140 points off the lows of the day is where the Nifty stands. 25,728 was the intraday low. So now, as Rohit also highlighted earlier on in the show, that 25,800 is one level where supports will emerge and the index is trying to hold on to those levels. Good time to get in a check from the FNO desk. Sudarshan is here to tell us just that. And he told us in the morning that it will not be surprising if you see a recovery from lower levels. It's not exactly transpiring right now, but Sudarshan, does that recovery sustain as we go into the second half?
So ahead of weekly expiry, there is an expectation that volatility will continue, but good part is that market has seen a smart recovery from intraday lows, and that was led by heavyweights like Reliance, Infosys, and we have also seen some recovery in some of the PSU banks, names like SBI and other PSU banks. Now, what will Nifty try to do is that Nifty will try to protect the levels in the range of 25,800 to 25,850 because the recent low was of 25,842. If Nifty fails to hold that level, then there is a probability that it might go to as low as 25,750. So what are some of the major reasons that why Nifty or say market has recovered from lows? First, put call ratio. Yesterday, it had fallen to 0.66. So normally when we fall to the level around 0.6, we go into the oversold zone. So that was one of the reasons that we have seen recovery. Now, take a look at volatility index. When we opened today, it was up almost 6%. Currently, it's just up 1.5%. Another reason is, take a look at rupee. Intraday low was around 90.10. Now it's back below 90. That is also one of the reasons why you are seeing a recovery in some of the major PSU banks. Now come to the options data. On the put side, two options that are the most active ones, 25,750, where the premium has risen to 14 from the earlier level of 8, and 25,850, where the premium has increased to 46 from 23. On the call side, there is a sharp increase in the open interest, and at the same time, there is a sharp fall in the premium. So 25,950, premium has fallen to as low as 30 from the earlier high of 99, and for 25,850, premium has fallen to 52 from 136. So support, as I told you, for Nifty, 25,800 to 25,850. Resistance would be around 26,000. That's the psychological level. For Nifty Bank, support would be around 59,100. This is the one of the important, amongst all the frontline indices, it's the one index that has seen a sharp recovery, and resistance would be 59,700. Some of the stocks that are seeing fresh longs and fresh shorts, fresh longs, PG Electro and SRF. On the fresh short side, Hero MotoCorp.
Oh, yes. So some recovery. We'll have to see whether that sustains or not. Thank you so much, Sudarshan, for joining us with that F&O update. Let's get in Sneha Seth from Angel One, joining us for a quick technical check. Sneha, what are you making of the moves that we are seeing now? Do you think we'll see this recovery continue? What are the important levels to watch out for on the Nifty now?
So very good morning. If you look at the market yesterday, yes, a few of the data were a bit oversold. And today, the kind of opening we saw and then the kind of fall we saw, after that, we had seen decent writing in put options. Now, even the put writers have been, adding positions at 25,700, 800 strikes. So I believe for today, we may close about 25,800. And on the higher side, for today's session, I believe 25,900, 950 should be acting as a resistance. So this is the range for Nifty for today's session. Not expecting a major move beyond this range for now. In case of any move above 25,950, that would be an interesting development. But as of now, looking at the options activity, I believe this is the range. As far as individual counters are concerned, I'm liking Aditya Birla Capital. Now, if you look at the chart structure, this counter has been very strong recently, continuously trading above all the moving averages, making a new highs today. So I believe one can go ahead and long this counter, keep a stop around 355, and the target expected will be around 375. Apart from this, the next counter which I'm liking is Federal Bank. Now here, if you see the chart structure, recently we have seen some consolidation. And now again, from the lower levels, we have seen some buying interest. This counter also looks very appealing for near-term perspective even. So I would recommend buying this counter at current levels. The stop loss can be maintained around 254, and the target expected will be 270.
Aditya Birla Capital in a market like this at a 52-week high today, and also now has doubled on a year-to-date basis. Neha, thank you for sparing time and joining us today with your views on the index and on specific stocks as well. Take a break. More on the markets on the other side. Stay tuned.
"26 years.
Welcome back. You're still tuned in to Trading Hour. Yes, there is some recovery which is underway, but there's an interesting data that has come by on the back of MTF borrowings. How much has this number increased, and what is the outcome of this one? Of course, MTF is margin trading facility. Hormuz, it has increased substantially versus 2020.
Yeah, substantially indeed. And, we first visited this in September when Ruchit and Yusuf put this data together. And from the end of 2020, when that figure stood at around 7 7,500 crores. It's a 14x jump from those levels in just 5 years. So as of yesterday's closing, that number stands at 1.1 lakh crore. That's the MTF borrowings that you have currently for retail shareholders. Now, even if you take a look at the year-wise chart, you would see the increase that you have seen. Last year, it was around 82,000 crores. When we first visited this in September, this figure was around 94,000 crores. And now within the next 3 months, that number has increased even further to around 1.1 lakh crore. And you look at the number of shares as well, over 2,000 shares where over MTF borrowings are currently in place. But what exactly is this MTF? Now, it's a facility that is offered to traders by the brokers, and this is to allow buying of more securities compared to your current capital that you have. Now, for example, if you're trying to buy something worth 1,000 rupees, but you don't have that kind of amount with you, you can do an upfront payment of around 200 rupees, and the rest is funded by the broker. So what happens here is, in a good market, in a bull market, when things are going fine and everything's moving higher, if it in a leveraged trade, you would get outsized returns, but that's where the risk lies as well. In a market like today's, when you are extremely choppy and stocks falling the way they are, you've seen that capitulation take place in a lot of these stocks in the last few days. When the stock price falls, the brokers will have the right to square off the position if there is no additional collateral that has been put in place. So if that happens, this forced selling can intensify the pressure in the markets and amplify those losses. So that's something that you saw yesterday as well. It almost felt like there is capitulation taking place in the small caps and the mid caps. Now, so a lot of brokers who we spoke to said that margin selling was responsible for this. Vikas Khemani was on air today. He also mentioned that he heard about margin selling taking place. Now you look at the stocks as well, where you have these most traded MTF names. HCL is one. It was at the top of the list in September as well. Trent has made an entry here. There's 1,100 crore rupees worth of leverage trades here. BEL, and you take a look at the others also. The other names, the last 5, you have those names where there are the retail shareholding is the highest. Suzlon, Yes Bank, Tata Motors, passenger vehicles, all of them have very, very significant retail shareholding, and as a result of which you could see that kind of leverage trades being played out, and that was the kind of, that could be one of the factors you saw the market behave the way it did in yesterday's session.
Okay, retail investors getting over leveraged. That's the takeaway from this data point put together by our colleague Ruchit Purohit, who also is the producer of the show that you're watching currently. But of course, an important update coming for you. DGCA has ordered Indigo to cut their flights by 5% for the month of December, the remaining time period that is for their schedule. And they have to give up an update by 5 p.m. on December 10th. They have to reduce the winter schedule by 5% across sectors. And they also mentioned it could be for routes which have other alternatives as well. So we'll keep tracking this news for you. The Interglobe Aviation stock saw a big fall yesterday. It has been flattish but with some negative bias. Saw that recovery at around 10 a.m. and it has continued to build up on that. We'll get our colleague for more updates on this one and the detailed analysis of this notice as well. But we'll slip into a short break. When we come back, we'll get you more on the markets on the other side. Stay tuned for that.
26 years of CNBC TV18.
Welcome back. Continuing with the update that we were talking about before we went into the break with regards to Indigo, the DGCA has curtailed the airline's winter schedule amidst widespread flight cancellations. Shivani, who's been tracking this, is joining in with more details on this. Shivani, tell us more.
Well, Hormuz, that's correct. We had reported this morning that 5% of Indigo's flights are to be curtailed, and DGCA has already communicated to Indigo, and now we are seeing that the official notice about this is out. So what we now know is that DGCA has said that Indigo has failed to demonstrate an efficiency to run all these flights that they had submitted for the winter schedule. So on the basis of that, now there are numbers to support this claim by DGCA, and that is that in the entire month of November, 591 flights were cancelled from Indigo, and that is before all of this disruption started on 1st of December. So 591 flights cancelled shows DGCA that Indigo is not capable of running the number of flights that they had submitted for the winter schedule. So now a 5% curtailment and cut, and which is by far right now the first step towards it. We are also getting to understand from sources that this might increase as and when DGCA sees that if Indigo is able to run and operate the kind of flights that they have on their winter schedule right now. So 5% cut, which means 100 to 115 flights a day, daily on Indigo routes where there are other operators as well. Say, for example, on routes where there is crowding, there is Air India as well, SpiceJet as well, Akasa as well, and there are a lot of Indigo flights. Those are the routes where Indigo has been asked to curtail flights so that there is minimum inconvenience to the passengers. Now, Indigo has also been asked by DGCA to submit a revised, winter schedule by 5 p.m. tomorrow, which is 10th. So that will be interesting to keep a track of on which of these routes Indigo is basically cutting the routes on. So that's what we are understanding right now, and clearly comes on the back of the disruptions that we saw.
Okay, all right, Shivani, thank you so much for bringing us that update. So that's about Interglobe Aviation. But it's time for a short break now. When we come back, we'll get you more on the markets on the other side. Stay tuned for that.
"26 years of CNBC TV18.
Welcome back. You're still tuned into Trading Hour. Let's talk about CG Power, company that became a $10 billion company after going under bankruptcy. CNBC TV18's Prashant Nair caught up with the Murugappa Group veteran and Srinivasan on the turnaround story and a lot more. Listen in to the excerpts of that conversation.
Be a stressed asset mechanism. It only takes care of the secured creditors. I think it should be extended to cover. It's outside IBC. But at the same time, if it can be a little more enlarged, then, it can be a quicker resolution of many things. In fact, immediately after this, I wrote to the RBI governor that saying that this is, and also to the finance minister, that this is a very good initiative. This is born out of IBC. At one point of time, IBC got, some provisions of IBC circular actually got stuck down by the Supreme Court. So there was a vacuum. So that time, RBI came out with the circular, interim, to deal with that. It became very effective. For this can be, if this can be enlarged and then it can be a quicker phase, everything need not go to IBC. IBC it's a clock. Once you set it up, it goes like this. And then in between, people can go and take a court stay, etc. It's more like a bilateral, agreeable thing. Therefore, this is a very good suggestion. And if this can be implemented, several assets, non-performing assets can be brought to life. The first 4 months of 2021, the company was acquired in November 2020. The 4 months itself, we did about 1,000 crores turnover, which was the highest in the last 7 or 8 quarters. Yeah. So initially, for the past 3-4 years prior to that, no money was spent on the company. There were no maintenance, nothing. So I just gave them roughly about 50 crores for each one of them. Whatever you want to do, you do. I don't want any downtime. I don't want, there is no time for me to just get into this. Your interests are as good as mine.
You could gauge that these people were...
they were all people who have stayed for so many years, and even they stayed during the stress period. They didn't want to go out. There was a pride. CG is my company. Then I had worked hard. And we must realize that the plant did nothing wrong. And for something happened at corporate, they got into this kind of a mess. This is the first one. Then since most of the creditors were settled, then for the next year, for the year 21-22, I told them, you come out with an unbridled business plan. You work to your potential. You don't bother about constraints. You tell me whatever money is required, what are the constraints, etc. I will deal with it. But you must focus on bringing up the company because recovery has to be faster. Then I found that, I had so much of issues to be dealt at the corporate. I have to deal with investigation. There was one big property transaction. If I
consumer land sale.
So if I close it, I can get about 400 crores, 450 crores. My target was that I wanted to get the money in 21, 22. Then also I wanted to recast the balance sheet, complete the recasting of balance sheet and get something. Only then I will know what are the risks. I myself do not know.
The 5-year recast was initiated by the company or was
No,
it?
by the Ministry of Corporate Affairs.
Yes.
Corporate Affairs. Yes. So realizing all that, I felt, unless I empower the people and then, I can't do both, then I call them. So you and I agree on certain major parameters and then cash flow. Then I set up an investment committee. Capital expenditure will have to be scrutinized by the investment committee. We have CFO, myself, everybody will be there. I constituted the team. And then they have to clear that your IRR, your cost, etc., everything is good. Subject to this broad parameters being agreed, you will be permitted to incur the expenditure, but you are accountable to give me the results.
An exclusive conversation there with the management of CG Power. But look at the recovery in the broader markets. The mid-cap index is now in the green. The small-cap index is now 0.3% higher, almost 50 stocks. It's a 50-50 on the mid-cap index, and the small-cap index is now tilted towards the gains. So take your leave on this edition of Trading Hour on this optimistic note from Sonal and me. Thank you for watching. Halftime report on the other side.
"26 years of CNBC TV18.